All right, good morning, everyone. Not investing in UXR destroys revenue and adds invisible leverage that will accelerate this destruction. And how does this manifest in reality? $1.4 trillion are lost in poor UX every single year. And what does 1.4 trillion look like? That is equivalent to $1 million spending per day for your company for nearly 3,000 years. It's also equivalent to about 10,742 years of income for a mid-sized company of 500 people. And it's equivalent to 25,000 years of Stephen Curry's star power. Go Warriors. But if that's the case, if UXR is so important, how come it takes 8 years for companies to hire their first UX researcher? And how come the researcher to developer ratio is 1 in 50? When you take a look at this chart, it shows the typical hierarchy for a tech company. And as you can see, UX research tends to be siloed within the product organization, making it difficult for UX researchers to have an impact beyond product. And in the conversations that I've been in, typically, when UX researchers do have the ability to influence teams outside of product, they tend to not have the language that will help them be impactful, the language of the business. But today, we're going to change that. I will be walking everyone through this model that I built over the years called the UXR Valuation model. And the roadmap for today's conversation is essentially, first, we'll introduce this concept called return on equity. Then we'll transition into net operating revenue, which measures what you earn from your investment. Then we'll transition into leverage, which measures invisible debt. And finally, we'll put it all together. So today we'll be talking a lot about finance, and it may come as something new to a lot of you, but don't worry about it. I'll break it down into pieces, and we'll have a ton of time to practice. Let's start with return on equity, or ROE. So when you think about return on equity, think about a home. When you purchase a home, you hope that one day in the future, you could sell your home at a higher price than what you paid for, and the price that you pay for when you take out a loan for your mortgage. And that's exactly what CFOs and CEOs care about. Because when you start a company and you get investments from, let's say, VCs or private equity firms, the goal of those investments is to provide higher return on equity. You want to provide higher value to your shareholders. And UX research does that. It's fascinating to see how much UX research drives return on equity, and we'll see that today. Essentially, the formula of return on equity is a function of net operating income plus leverage. We'll break down this formula into individual steps, and I'll walk everyone through case studies that describe the examples of these different steps in the formula. Let's start with net operating income. So net operating income is basically operating income minus expenses. If you are an investor in the markets and you've seen a Form 10K before, you can really find net operating income as a line on the 10K in basically all of the 10Ks. This is one for Google or Alphabet as an example. When I think about how net operating income resonates with UX research, I think about this truffled mashed potatoes. I used to make this so much when I was in Indonesia, and everyone loved it. And when I moved to the United States and I started making it for my friends, no one ate it. So when I met my husband many years ago and I went to a first family gathering for Thanksgiving, I made it. But then I noticed that someone else also brought mashed potatoes, and I really wanted people to eat mine. So I put my husband as a plant in front of my mashed potatoes, and I won. Everyone ate my mashed potatoes. And so when I think about it, I realize, was it really my mashed potatoes that drove people to eat it? Or was it the fact that my husband was the plant, and back home in Indonesia, I think my brothers were the plant as well. So that's what UX research does. UX research drives recurring revenue. And some of those drivers may not be as obvious as typical drivers of revenue. When we think about typical drivers of revenue, we think about sales. But UX research is a strong driver of revenue. And so we transition into the first case study that I'd like to share with you all. In this case study, in this particular company, lost revenue was often attributable to pricing issues, the product being too expensive, people not having enough cash for a particular year to repurchase the product. Preference was the second reason, and then product was the third reason. But I was curious, are we really solving the right problem? Is it really pricing? And so we analyzed 5,000 rows of closed loss data and did a pretty robust regression model. And what did we discover? Interestingly, it shifted. Product was actually the most significant driver of these closed loss deals, leading to a loss of around $500K in revenue if we don't invest in product. And so my next question is it product and user experience, or is it product like missing product features, which is often, it could also be the case. And so we did a deeper investigation. Lo and behold, we discovered that ease of use was the most significant product reasons, leading to $400K loss of revenue. And if we did not do this investigation, this particular company would just think that sales is the main driver and not realize that UX investments could save them $400K in revenue. And imagine for a startup how big this money is, like the sum of money is. And so back to our ROE formula. It's evident that investments in UX research leads to positive increases in net operating income. Ready to talk about leverage? All right. So leverage is simple. It's basically total company debt. And again, looking back at the 10K, you can see that it's always listed also on the Form 10K under liabilities. How many of you are Friends lover, or you watch Friends routinely? I know I watch it all the time, over and over and over again. When I think about leverage, I think about this one scene when, if you all know Monica, she's always this very neurotic person who's super clean and super neat. And then one day, her husband Chandler tried to find out like what's behind this door. And then he spent the entire day trying to break the door open, opened it and found all of Monica's mess over the years hidden behind these doors. And that's the thing with liabilities. A lot of liabilities are seen. So if you take a loan from the bank to start your business, once they're realized, they're seen. But that's the practice of accounting. The liabilities that you have to report on your balance sheets are the ones that are realized. And so there are a lot of invisible liabilities that aren't realized yet, that you don't account for. And that's UX research. So UX research is one of those invisible liabilities. And I'll show you how that is through the second case study. So in this particular case study, this company's objective was to reduce support call volume, as many companies do, since support calls can be expensive, especially if they're repetitive. And this company actually succeeded in year one. Around summer, their support calls started decreasing. And what's interesting is in year two, around the same time, there was a drastic increase in support calls as well. And we wondered why. So similar to what we did earlier, we analyzed 9,000 rows of support call data and did a machine learning text analysis. And we discovered that these support calls were actually driven by 3 major UX issues. And if we break this down even further, the 3 major UX issues led to about an average of 5 repeat calls with 30 minutes each, and $1 per minute per call, which actually led to $225,000 of loss not accounted for. And that's the scary thing about these type of invisible liabilities. Because no one can see invisible liabilities. That's why it's invisible. And if you work for a public company, and let's say your stock is doing well in the market, once you realize these losses, these are going to go on the earnings report. And that will impact not just the equity that's out there, but even the equity that you also own as an employee in that company. So back to the ROE formula. We see that leverage has a negative impact on ROE in general. So let's put it all together and do a quick calculation. Again, a reminder of the relationship between net operating income, leverage, and ROE. So let's imagine that we're all today consulting for a startup called Freshly. Freshly brings fresh farmers market produce to your home. And let's say Freshly has about $3 million in income, $2.5 million in expenses, and $1 million in leverage. How do we calculate Freshly's ROE? I have the formula over there, and let's go through the steps together. So first, you would calculate net operating income, which is just 3 minus 2.5. Then you would try to find the leverage, which here it's simple, it's 1 million. And then the ROE in this case is positive. It's about $1 million. So Freshly is providing a positive returns to its shareholders. But let's say us UX researchers discovered something interesting. So it's the same scenario, $3 million in income, $2.5 million in expenses, and about $1 million in leverage. But then us UX researchers, we discovered that if Freshly were not to improve a particular feature, they would experience about a $600K decrease in income. And then if they don't invest in that same feature, they would also experience a $150K increase in call center costs. So what does this do to ROE? Net operating income remains the same until we input $600K in, then it becomes negative. And then leverage, once we add the leverage of the extra $150K of increase in cost, that's a lagging liability, the leverage becomes a little bit higher. So when you think about the maths in this, you have a negative income, and then you have a higher multiplier for the negative income. That leads to a pretty significant loss in the value that you'll provide to your shareholders. Back to what I mentioned earlier in the talk, not investing in UXR destroys revenue and adds invisible leverage that will accelerate this destruction. And we saw that in the 2 case studies and the example that I just went through. And the power of financial analysis really isn't limited to the 2 things we just saw today. I talked about income and I talked about leverage, but there's so many other ratios and formulas that you can use that I've listed here. And it's not really about calculating the formulas, because as an investor also, I can tell you that not everyone does their due diligence properly. What's more important than calculating the formulas, especially if you don't have time to do it, is learning to talk the language, learning to use all of these terms so that you can be really impactful when you're trying to extend the impact of UX research to the entire ecosystem that is the business. And so how do you talk the language? This is how I would do it. Instead of saying, based on our studies, we should invest in building feature X because it will improve user experience and make customers happy, I would say we should invest in building feature X because it has the potential to create value through improving ROE by way of revenue. Instead of saying users find this product difficult to use and it's going to cause lots of problems down the road, consider saying users find this product difficult to use and it'll cause UX debt that will lead to an invisible liability and eventually destroy revenue. How powerful would that be to be able to say this? Instead of saying investing in this feature will make our customers happier and they will use our product more, consider saying that investing in this feature drives customer lifetime value, which is a ratio for loyalty, and ultimately stronger ROE over time. And finally, if you're advocating for headcount, which I know we're all doing one way or another, instead of saying, I need more headcount for my UXR team because there is more demand for our work and building user empathy is important, say this instead. Adding headcount to my UXR team is important because our team identifies strategic revenue generators and uncovers hidden liabilities that can eventually be damaging to ROE. And we actually do that, and we have a way to measure that financially as well. So what does this all mean? A recap of the 3 main things we learned today regarding the relationship of UXR and ROE. First, UXR improves and maintains profitability. Second, UXR hedges against uncertainty by reducing invisible leverage. And that's particularly important because I strongly believe that we are entering a recession. And recessions are fraught with so much economic uncertainty. And companies and leadership will try to find ways to quantify that uncertainty. And we have the power to do that. And finally, UXR helps your company provide higher returns to shareholders. Whether times are good, whether times are bad, we have the ability to help companies thrive. I'd like to end by showing you something really interesting. So this chart shows the S&P ESG index. ESG is basically Environmental Social Governance Index, and prior to the 1960s, very few large organizations, large cap organizations, actually care about the environment. Only recently did investing in organizations that are conscious of the environment became a trend, something that actually these organizations care deeply about, and they want to make sure that they're part of this index to show that they care about the environment. I'd like to talk about a world that I believe in. In this world, prioritizing the human experience, prioritizing humanity is not a trade-off to profit. In this particular world, UXR is at the center of a company's profitability and valuation strategy. And so I dream of a world where UXR is considered a core part of the company's strategy. Because in this world, UXR is both a moral and a business imperative. Thank you so much.